2.2% quarter-on-quarter. Our rupee revenue grew by 5.4% on year-on-year to reach 62,613 crores. We achieved an operating margin of 24.7% after absorbing the annual wage hike. This translates to 15,442 crores of operating profit. Our net profit for the quarter has come in at 19.2%, translating to 12,038 crores. Consequently, our EPS reached 33.28, up 9.9% year-on-year. Cash from operations at 11,168 crores represents a conversion at 92.8% of net profit. As mentioned in this quarter, almost all verticals and markets achieved positive growth on a quarter-on-quarter basis. On a year-on-year basis, UK grew by 6%, North America degrew by 1.1%, and Continental Europe by 0.9%. The new growth markets of India, Asia Pacific, Middle East and Africa and LATAM continue to display strong growth, supporting our diversification strategy. Especially, our revenue from India grew by 61.8% year-on-year. Among the verticals, manufacturing and energy resources and utilities continue to have strong growth. Manufacturing grew by 9.4% and energy resources and utilities grew by 5.7%, and life sciences grew by 4%. TCS banks had a strong quarter with a number of wins across multiple geographies. BFSI, consumer, tech and services and CMI continue to have negative growth on a year-on-year basis. We had another quarter of improving customer metric. The number of customers from whom we make more than 100 million rose by 3 to 63 customers on a year-on-year basis. There has been strong customer movement across all other bands also. In addition, our customer base of 1 million stands at 1,310, an increase of 42 over last year. Our order book closure for the quarter stands at $8.3 billion. Our order book for North America stood at $4.6 billion, BFSI at $2.7 billion, and consumer business at $1.1 billion. In Q1, our net employee headcount addition compared to Q4 was at 5,452. Our global employee headcount at the end of Q1 is at 606,998. Our attrition moderated to 12.1% from 12.5%. The board has proposed an interim dividend of 10 rupees per share. This is in line with our practice of returning 80 to 100% of free cash flows back to our shareholders. We continue to see strong traction for our AI offerings in the market. Our Wisdom Next platform that helps the enterprises in adoption of Gen AI at scale has received very strong customer reception. The number of engagements going into production is steadily increasing. We are currently executing about 270 AI projects across TCS. Our AI and Gen AI pipeline has doubled in the quarter to $1.5 billion. Our investments on research and innovation continues. In Q1, we applied for 154 patents and were granted 277 patents. With those updates, I hand it back to Kritika and we'll open it up for questions. Back to you, Kritika.
Thank you so much, Kriti, for the opening address. We'll start with the question and answers. As always, request everyone to keep it to 2 questions so we can accommodate everyone. We also have a few journalists joining online. We'll start with Reema Tendulkar, CNBC TV 18.
Gentlemen, good evening and congratulations. Kriti, first question on revenues. Is this kind of revenue growth sustainable? Do you anticipate a pickup as the year progresses, and your view on discretionary spending? And also throw some color on the deal wins, because it's lower quarter-on-quarter and on a year-on-year basis. We understand that it's lumpy, but say for the full year, FY25, do you think the deal wins can be better than what we had last year, FY24? At least do you have that kind of confidence? Samir, on margins, it's a strong performance considering the wage hike, but it appears that your employee cost as a percentage of revenue has come down, which raises the question that have you given out less to your employees this time compared to the past, or is there more increased offshoring? Subcontracting costs we know is an element, but other than that, and Milind, do you think you can continue to add to your headcount in the coming quarters? Is that the confidence you have? And even on attrition, the way forward? Thank you.
Thanks, Reema. First of all, as I said, we are quite happy with the all-round growth in across all verticals and markets. That's the most important message for us. Your question of whether we can sustain this growth, we are not going to call that explicitly. We still believe it's too early to call whether the growth momentum is sustainable, because the market conditions continue to remain same as it was last quarter. So there is nothing new to add in terms of market sentiments. But we, at the same time, last quarter we mentioned that we believe FY25 will be better than FY24. We continue to hold that stand, and we are looking forward to a better FY25 compared to 24. In terms of order book, like you said, it is lumpy. But at the same time, what gives us confidence is the overall pipeline. Like we look at our qualified pipeline and total pipeline, which continues to be at a near all-time high. So it's more a question of timing on how much gets booked in a particular quarter. And the other point is, we believe like 7 to 9 at our current revenue range, we are looking at about 7 to 9 billion. TCV is a comfort range, and we are within that range. So we don't see any specific issue over there.
So Dima, on the wage increments, the overall impact of increments is 170 basis points, and that has been in line with what we have given in the past. Typical range has been between 150 to 200 basis points. Your question in terms of the manpower cost percentage, as you would have seen in the last 3-4 quarters, we have been driving better productivity, improved utilization, and reduction in subcontractor costs. The first two does reflect better on the manpower cost, and that balances out some of the impact of increments in this quarter as well.
I think with regard to your question on whether we will continue to add headcount, I think we actually have onboarded 11,000 trainees in this quarter. And trainees being, as I have been saying always, key strategy of basically developing talent at TCS and deploying. And that will continue, in this year. What the net headcount will be every quarter will be difficult to say, because it depends on many other factors. With respect to attrition, we are at 12.1%, 40 basis points down from last quarter. I think, I believe it will stabilize at this point with this number.
Thank you. Ankur Mishra from ET Now.
Good evening, everyone. While we understand that you are not calling it out and not giving explicit guidance per se, but you are maintaining that FY25 will be better than FY24. I want to ask you here, which will be favorable parameters for you for changing the stance, and vice versa, which are the risks which you are seeing, and hence you are saying that you cannot call it out right now. On the operating margins front, there is 1.5% increase year on year. Can you give guidance at least on that part? Will you be able to maintain that operating margin? And on the attrition rate, while you have maintained that this is the level where you will be able to maintain at near 12%, do you believe that from forecasting point of view, if I would say so, that attrition levels will not go anywhere from here?
Ankur, first on the parameters or what yearly indicators, both from a favorable or risk perspective, I would say, what is how much is the re-evaluation of the ongoing projects that's going on? Okay, if for customers continue to re-evaluate the whole discretionary programs, and some of them get passed, the rate at which it gets passed, that's probably an indication. Second is the sentiment in terms of how much they want to go towards cost optimization, how much they want to invest. These are the parameters that would also give us the confidence. And as I said, like this, in our view, remains very similar to last quarter. That's the reason we're not ready to call out whether the growth momentum will sustain.
So, Ankur, typically the biggest headwind which we have is what we take upfront in the financial year, and that's what has happened. And typically we claw back and inch up in each of the next quarters. And we'd expect that journey to continue. if you look at FY24, we had, after taking the initial increment impact, we ended up almost 100 basis points in each of the next 3 quarters. And that was driven through significant driving significant operational efficiency. And we stay focused on driving operational rigor in our operation.
With respect to attrition, 12.1% where we are at right now, and I obviously cannot predict for the future like everything else, but I think I'll say that we'll be few basis points here and there, but we'll be in the vicinity of this in the coming quarter.
Thank you. Sajid Mangat from NDT.
If you like this video, then like, share and subscribe to ET Now.